Hi, I'm Kevin Flanagan, Head of Fixed Income Strategy at Wisdom Tree.
And I'm Jeff Weniger, Head of Equity Strategy. And this is Minds on the Markets, where we go behind the scenes and beyond the trends to explore the forces impacting our markets. And welcome back to the Minds on the Markets YouTube series. Hey, by the way, if you ever want to read what Kevin and I are talking about, you can always go to the Wisdom Tree website. We do a one-pager on this every couple of weeks. In this case, Kevin has been parsing through really kind of the GDP math. There is that written report that you could find on the Wisdom Tree website. And I think it's really critical because, Kevin, you got imports going. This is the official chart of the imports right here. We have people front-loaded back in February. Well, I guess you could even say January and February, maybe even into March. You got your imports in because you wanted to get in front of tariffs. You have these big import surges. And I think maybe some people don't fully appreciate that what that does is subtracts from GDP. So we had a lot of wild news flow in the last 4 to 6 weeks. So can you walk us through really how this all works in trying to figure out what is GDP growth in the United States at this moment in time?
Well, I mean, we're kind of back to where we were a couple of years ago. Remember after the Fed rate hikes, it was always which year was going to produce a recession. And then that kind of cooled off. Then you get the tariff announcements, the expectation of tariff announcements, and the R word is back in vogue. So, textbook, I remember 8:30 a.m. Econ 101. Oh my gosh, it was almost as bad as my accounting 101 class going to school for. But anyway, 2 consecutive quarters of negative GDP equals a recession. So we contracted by 0.3% Q1 of this year. According to the textbooks, we're halfway to a recession, right? But, it's kind of like, are we really or are we missing something? Jeff and I are not the duo who's going to come at you and try to explain away things. But sometimes you do need to go into the heart of the report. So GDP, it's 5 cylinders of an engine. It's consumption, it's investment, it's trade, to what you said, imports, it's inventories, and it's government spending. So 3 out of those 5 cylinders of the engine were positive. And if I were to have said that to you prior to the release of the report, you would have thought, oh, well, more than likely GDP will have a plus sign in front of it for the first quarter. But it didn't. And it was because of what, Jeff, you specifically pointed out. The level of imports were up 41%. So they blew everything away, eclipsed any of the positive kind of performances. So that leads you to believe, well, should we be looking at something else? Is that then not like, the real state of the economy? And it's funny because that's what the Fed was trying to focus on. And we heard it from Powell at the May FOMC meeting as well.
Okay, well, then I guess you're queuing us up here on the Federal Reserve because we have a lot of moving parts there. I mean, some of the regional Fed surveys are saying on the prices paid side, you got these charts are kind of going higher. People are getting in front of tariffs. Some of the tariffs are starting to hit. We got the CPI is going to increasingly in the April, May, and June data start to reflect a lot of the early tariff policy, which was, remember here, Kevin, the initial announcements by Trump for tariffs were back in early February. So it's going to start showing up in the data. Where are we headed here in terms of the central bank?
Yeah, well, it goes back to what I was mentioning. So Powell and company are going to look at this number called real final sales to private domestic purchasers. Don't be scared by it. It's not a big number. It's just consumption and investment. That was a positive 3%. And this is what the Fed, their challenge is going to be, to sift through the data to see what is the underlying state of the economy, what is the underlying state of inflation, what is tariff noise. And I think that's what we're going to begin to find out and make the job very difficult for the Fed going forward. So that's why I look at what Powell said at his press conference. Monetary policy cannot be preemptive at this point in time. So, we got news about U.S. and China perhaps trade tariff breakthroughs, right? That doesn't change the equation for the Fed. They're going to sit back. They're going to let the data come to them. So when you sit there and you see Fed funds futures, 4 or 5 rate cuts, 1 or 2 rate cuts, just take it with a grain of salt. If Fed's just going to wait, let the data come to them, maybe you get 1 or 2 rate cuts from the Fed this year, but it's going to have to be because they're seeing signs, I think, of labor market deterioration, because they are going to be concerned about the inflation side, right? They don't want to have to use the T word, transitory, and say, hey, you missed the boat on that like you did 3-4 years ago. So I think the Fed's going to be very cautious, very patient.
Okay, very cautious and very patient. And also on some of the comments that Kevin was making in terms of the little respite on the U.S.-China front. We also had, called about 5 or 6 days ago, we had the Prime Minister of Japan talking about maybe 0 tariffs with the United States. So you got that one in coordination as well. All right, look, make sure that you're liking and subscribing. Hit the website. So if you like reading the written word, we put these out. And of course, there's the blogs and the research pieces that we do at Wisdom Tree as well. So for Kevin Flanagan, I'm Jeff Weniger. This was Minds in the Markets.